Hi, everyone. This is Jason Burak for Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I've been friends with him for a while, and I've been talking with him and consider him a mentor. Is Eric Dubin. He's the news editor, managing editor of thenewsdoctors.com. Let me read his bio very quickly. He has 24 years of experience as an independent buy-side securities and global macro analyst. He has well over a decade of experience as a financial journalist, editor, and political analyst. He's primarily an autodidact, but his formal education includes degrees in economics, international relations, and an MBA. So thank you for joining us, Eric.
Nice to be here, Jason. Thanks.
Now, Eric, we were talking about this before we started recording about the Swiss depegging their euro peg. Their euro peg was just getting so massive. They were printing so many Swiss francs to buy up these euros, and I think they had over $300 billion worth of euros in their reserves already. And why do you think the Swiss just suddenly decided to cancel the peg?
It was even more. It's up to $500 billion now, and with the run rate, it'd probably be well over $600 billion this year. It was just too expensive for them, first and foremost. I mean, it required them to take down what is amounting to about 100% of the GDP of Swiss, production. So they, in essence, in a roundabout way, were subsidizing the EU, and maintaining that peg allowed Draghi and the central bankers in the EU to be more liberal with their limited quantitative easing. And then when the Swiss bankers are looking on the horizon, seeing that the ECB was most likely going to do aggressive QE this week, they decided to front run it and get in advance of that. And there were some indications that this is the way the Swiss were going to be thinking about it too, because back on, I forget the exact date, but it was in the middle of December, they announced that they were going to initiate even more aggressive negative interest rates in advance of the meeting in the ECB on the 22nd of this month. They, in fact, have now announced that the interest rates will be notched down by 75 basis points. So it's really in the best interests of the Swiss to just go back and take control of their monetary system and no longer have a peg and be subservient in terms of their financial sovereignty to the ECB.
Yeah, the Swiss exporters will obviously be upset, and there's large special interest groups there. There's a lot of corporations in the U.S. that moved their corporate headquarters on paper to Switzerland, but it's really just a PO box. But it seems to me that in the long term, none of these currency pegs, whether it's the Hong Kong dollar pegging to the American dollar, or it's China with their dollar peg, none of these currency pegs work. But these Keynesian central bankers, they read it in the textbooks, and they just keep going back to it. I mean, if you would have told me when we first started, when Switzerland first started with their euro peg, what the hell are they doing, right? This is going to end really bad, but yet they did it anyway, and maybe, it didn't blow up in their faces initially for the first year or two or three, but obviously, someone with any type of common sense knew that eventually it was going to get to this point.
Yeah, well, if you roll back the pages of history to when they launched the peg in late 2011, in that period of time, the public perception worldwide was, well, gee, QE worked for the United States. It saved the economy. I mean, the S&P 500 went to 666.67 or so. Interesting stopping point for the crash back in March of 2009. But in any event, by the time 2011 had rolled around and we had QE2 going, and the real estate market had, bounced back in a big, very powerful dead cat bounce, which we are now rolling back over from. All of these things were basically emboldening the Keynesian central banker thesis that, hey, QE can actually rescue an economy. Never mind all of the other factors that actually made the United States rebound from that preface. The things that you actually talked about a lot on many a different show, with the gigantic currency swaps that the Fed did with the ECB, upwards of maybe north of $30 trillion. I mean, we don't even know the real numbers at this point. But that period was basically the context in which the Swiss National Bank decided to make that decision. And it's kind of understandable why they did what they did, because they wanted to basically help the euro and help the European Union, in fact, stay together, and in the context of dealing with the Greece situation. as you know, currency pegs always fail. I mean, that's just a historical record. And the QE always fails. I mean, the best case that anyone could look at would be Japan not, completely falling apart in 20 years, but having gigantic stagnation and the problems that are apparent there, where it speaks to QE not being able to fix. You cannot fix a debt problem with just adding more debt. It's asinine.
Exactly, and Japan was the only country doing that at the time.
Yeah.
So they were, exporting their with the yen carry trade, they were allowing asset price bubbles in other countries to be done. So Wall Street hedge funds and investment banks and those types could borrow, Japanese yen near zero and do carry trades and speculate on bubbles in other markets. But it just seems, you brought up that maybe the Swiss central bankers were trying to help out the euro. Maybe that was part of it. But, Keynesian economics is mercantilist economics. And in the textbook, these guys just talk about, we need to boost exports. We need to lower our currency. Well, everyone's trying to do it.
Right.
So we're just in a currency war now. And, we have these Wall Street shills saying, oh, we're not in a currency war. But we have, when you listen to the central bankers talk, whether it's from Brazil or other countries, before Jim Rickards' book Currency War, which I think is a must-read for everyone, comes out and explains kind of what's going on right now, you had the central bankers in Brazil and stuff like that talking about currency wars. So clearly it's going on where, these guys, almost all of them went, whether they're central bankers in Brazil or central bankers in Russia, a lot of them went to either the London School of Economics or Ivy League schools here in the United States, and they were all basically taught from the same books that, when in doubt, we need to drastically devalue our currency to boost exports. And when everyone's trying to do it, it just doesn't work.
Yeah, and then when you marry that with monetary expansion in the hopes of reviving economic stagnation, it's just a double-barrel shotgun blast. It's just, that's in particular what's different now than, say, Japan 15 years ago after, X period of time of them doing their QE. And other problems that we've had, in terms of credit market crashes. Now we just have global excess credit, and it's we've gone through a period where central bankers have been doing this round-robin trading off, where formal QE has been periodic. The United States started first, then the Bank of England came aboard, and then the ECB has done some, and they're now about to do a lot more.
And Japan did a whole bunch. Yeah,
and the myth right now is that the Federal Reserve is going to be raising rates at some point this year. In fact, John Hilsenrath, the mouthpiece for the Fed over at the Wall Street Journal, who supposedly has his ear towards the Yellen camp, had said, yes, it's probably going to be in June that we're going to see interest rates hiked up. And, by that time we're going to see the carnage in the oil industry and the amazing amount of junk credit that's there that's in trouble, beginning to impact derivatives. And, by March, when hedge funds and institutions on Wall Street start reporting what has gone on in this quarter, you're going to see a lot of dead bodies. And it's very unlikely that the Fed is actually going to be able to pull off raising interest rates. But, who knows? Maybe they'll squeak one in, and then all hell is going to break loose, and they're going to tuck their tail between their legs really quickly.
Yeah, I agree. There's a decent probability of that, where maybe there's a token rate hike, maybe a quarter of a percentage point. If they raise rates 1%, right, the U.S. is looking at another $180 billion added in interest payments on the debt.
Right.
And, that's going to take away a massive amount of the tax revenue going towards that. So, I mean, the U.S. it's not as far along as Japan is, where I think if rates rise 1% in Japan, 100% of the annual tax revenues will go out. But turning to the ECB now, we've had Japan blast out, further and further. The Japanese stimulus plan surprised the Keynesians, the mainstream Wall Street people. Didn't surprise me because I know Japan has a math problem. The demand there for bonds is not high anymore. The only person left to buy the bonds is the Japanese central bank. They're going to have to print an ungodly amount more yen just to prevent, everything from collapsing. But it seems to me, the Keynesians don't understand math, or maybe they choose to ignore it. They're either stupid or lying. I don't know which. Maybe it's both, some of them. But, the ECB has, the European Central Bank, for listeners out there, it has a mandate, right? It's not supposed to be able to do any kind of quantitative easing or printing. But it seems on Thursday, a lot of economists, these are mainstream ones, these are not Austrian school ones, but they expect a lot of them pulled. They expect, I think, $600 billion worth of quantity. Is that you think we're going to get that type of printing from Europe too? They're going to violate their mandate, and do you think then that Germany then will get angry enough to potentially leave the euro then if this does happen?
Oh boy, there's a lot of avenues that we can talk about just based on that question. So first, last week, the highest appeals court in the European Union actually ruled in favor of the ECB's ability to legally print money in this QE action. So that was actually one of the final nails in the coffin that kicked the Swiss National Bank bankers over the edge, and they decided to make the announcement that they did. It's going to piss off Germany. There's no doubt about that. And Holland and other northern European countries are beginning to kick around the idea and quietly talk amongst themselves about a northern euro. And the instability in Greece, there's already, just in the last couple of weeks, 4 banks there that are requesting monetary infusion to save them. Greece is not going to be able to pay off the debt under the terms that they have with the Troika governing their system, and it's going to most likely elect a more right-leaning government in a few days that will further alienate them from Germany and the more sound money thinking cultures of Europe. And I think that it's actually getting to the point where it's not inconceivable that the euro is going to morph. It won't die. It'll just change into a northern euro with maybe France tagging along. It's kind of hard to imagine the euro functioning without France. So the sick man of Europe, quote unquote, will probably be along for the ride, but that's where the line would be drawn. Spain, Greece, Portugal will probably fall out of the euro. And that'll probably be a good thing. And I'm talking about something that can happen in a time frame of 2 years or less. It'll definitely be a good thing for Greece because at this stage they can't pay back their debts. They can't deal with more austerity. You have youth unemployment that's approaching 50%. I mean, it's just a basket case there. They've sold off a lot of their national assets in an attempt to appease the debt collectors from the ECB. And they would be far better off looking towards Iceland as a model as opposed to trying to salvage their future by hanging on to the ECB and the monetary union with the EU. So I think that that's probably where, in the long term, things are going to go. But moving back to what's going to happen this week, I do agree that it's most likely that we are going to see a really big announcement of QE coming from the ECB, particularly given the fact that they've kind of sort of greased the skids when it comes to the legal ability for them to do this. So my call that I made earlier last Friday, actually, in the Silver Doctors Weekly Metals and Markets wrap was that expect at least $500 billion, and it looks like now that, and I was completely unaware what the consensus Wall Street economists speak was, but it looks like they're kind of in the same ballpark too. And that's probably what we're going to see. Bloomberg put out a story saying that 93% of the respondents, according to a Bloomberg News survey, say that it's going to be 550 billion euro or 640 billion U.S. equivalent. And when you get expectations built that size and the possibility that Draghi might not be able to get away with doing a political move of that magnitude of quantitative easing, you think the fireworks was interesting when the Swiss National Bank pulled the peg. My God, I mean, if they just don't do anything at this point, we're going to see huge volatility come into the markets on Thursday. So I think that it's kind of a fait accompli at this stage, that they're going to just go for it. And the signals that Draghi has been sending out in the last couple of months when he's been jockeying politically against the interests at the Bundesbank and the more sound money camp within Europe, if you read between the lines of that debate and kind of try to ferret out what's on the agenda for Draghi, this has all been building up. It's been somewhat predictable, and in particular when you see the Swiss National Bank saying back in December that they were going to go more negative with their interest rates in fear of the ECB making gigantic QE. The pieces of the puzzle fit together. So I think the probability of ECB actually coming through and doing $500 billion is pretty strong.
Yeah, I think so too. I think you had the experts like Axel Merck and Jim Rickards and some of these other experts out there saying, the ECB would never print money due to their mandate. That's not why the euro was created. They mark their gold to market, and, they won't print like the Fed does. The Fed will print instead to bail them out. But it looks like the European banks are just hemorrhaging so much, either in the derivatives markets or whatnot. The European banks were never recapitalized like the American ones were. They've gotten massive currency swap backdoor bailouts. Maybe with the Russian ruble falling so much and Russia's economy, things there are not working out as well with some of the sanctions and other stuff. Maybe there's German banks that have, besides just bad loans to Greece area, maybe they've also gotten hammered in Russia. But we've just seen so much volatility already in the currency markets. Whether that's the Japanese yen last year having an absolutely massive move, or the Russian ruble recently, or with the Swiss franc. And normally in the currency markets, they're very enormously large liquid markets. A couple percent move per year is considered a big move, Eric. But now the volatility is it's breathtaking in the currency markets.
Yeah, and to be fair to Axel Mark and Jim Rickards, 6 months ago, different picture. And further back in time, yes, you're right. They were saying that as their prognosis for the ultimate stance of the euro and whatnot. But, when we started going past July and saw this cascade decline in the oil and all of the various other confirmations that deflation was getting way ahead of the central bankers' efforts, and that we are now mired in this liquidity trap that is coming to bite us really hard, when we're even seeing that in lousy economic numbers in some respects, even with the government reported numbers in the United States, retail sales and so forth. The deflation dominoes are falling and accelerating. So it's somewhat of a different backdrop. That also fits into what's going on with Russia, and China's property bubble is beginning to implode, and they have a huge overhang with malinvestments in China. I mean, I'm not a complete bear when it comes to the ultimate prognosis for China's economy, as some people are just looking at this and saying, see, we told you so, all these ghost cities and 26% excess capacity in housing and so forth. That's really going to end up taking the whole economy down as China blows. And we see huge volatility. I think the Shanghai index was down over 7% last night. I mean, they definitely have gigantic problems.
Well, their stock market is still up a lot, I think, over the last 4 months or so.
Right.
I think that I don't think it has to do anything with fundamentals at all, because obviously you look and the Chinese are not consuming nearly as much base metals and things like that. Right. I don't follow a lot of Chinese companies super closely, but I do follow the commodity prices there. So
they had loosened credit a lot, and that's why the market went up.
Yeah, but it seems to me that, the point you brought up about the Chinese real estate market, that a lot of Chinese are panicking. They have cash. They're not buying as much real estate as they were, and maybe they're figuring, this money may go to zero because inflation already here is bad with the dollar peg and other types of stuff. And we're just going to go gamble in the stock market because it's tougher for them to get their they've been buying gold and silver too, but it's just tougher for them to get their capital out of the country. Yeah. So the stock market has risen a lot, I think, like I said, in the last 4 to 6 months, surprisingly based on no fundamentals, which is, what we see out of Japan. There's no fundamental gains there, and yet the Japanese stock market did pretty well last year. The U.S. markets, there's no fundamental improvements really here in most industries in the U.S. Almost all the full-time job creation, I think, in the U.S. since 2008 has been shale oil jobs, all the full-time jobs, and now those are about to go away, it looks like.
Yeah. In Japan, we had debasement of the currency driving the stock market, and in the United States, we have just the benefits of excessive liquidity pouring in, both domestic and flight capital. And so we got this crazy stock market bubble. But the credit market bubble is the godfather of all bubbles, and at this stage, the Fed is stuck. And at some point, this financial repression is a subject that you talk about a lot, and that's not going to be enough to fix what's going on here, because the overhang after World War II was resolved over a process of like a decade-plus length of time. The kind of debt overhang we have now is the biggest in all of human history, and it's downright scary what's going on. At some point, we're going to have some kind of date of reckoning and reconciliation with this debt, and we're probably going to have multiple periods where the bond market just goes through hiccups. It's very unstable.
Yeah, I agree. The goal, the game plan for the central planners, whether it's Japan or Europe or the United States, the developing world would like to do this, but a lot of them have to borrow their debt in dollars right now, so they can't do that. Maybe in the future that'll change when they can borrow in other currencies or different global bond markets are set up. But the name of the game is they want financial repression, all these developed world countries, and so far they've been able to keep things in financial repression more or less. We have bad inflation here in 2011, and then it calmed down a little bit, although there's still inflation now, but there's also deflationary forces too, so there's a tug of war,
right,
like Jim Rickard says. But it just seems to me, I don't think they're going to be able to keep things permanently in financial repression. Maybe they can keep things in financial repression more or less for another 5 years or so. I don't know the exact amount of years, but it's going to go one way or the other. It's going to be a 2008 type scenario where they lose control of everything, banks fail, asset prices drop, and then they say, what, we can't allow the asset prices to stay this low, because then all the asset holders in society are totally insolvent and they print again like crazy. Or they step on the gas, so the ECB prints, the dollar gets too strong. I don't think the global economy can survive a strong dollar and a low oil price. Maybe for a short amount of time, another 6 months maybe, the global economy can survive a really low oil price and a stronger dollar, but I don't think that can last consistently without debt defaults and the oil-producing countries starting to default too, because the majority of the world's oil production is just not profitable anymore at these prices either.
Right.
And there was a lot of petrodollar money, right, that was being recycled back into U.S. The Treasury market and other asset prices in the developed world. So that money is going away now because the countries like Russia, they have to spend the money on their own economies now to protect themselves.
Yeah, and then you layer on top of all of that geopolitical dynamics, and it really looks like it's not likely that the dollar reserve standard is going to survive in its current form. I think that the transition to a partial chipping away of 15% of dollar trade settlement and reserve status percentage. Right now we're somewhere around 60% of reserves stored in dollars and treasuries. The pushing up against the wall that the West is doing vis-a-vis Russia is compelling an acceleration of the establishment of alternative settlement systems and currency systems and bank setups for the BRICS Development Bank and so forth. And there's a debate going on, particularly in the precious metals community, saying that Jim Rickards is advocating the IMF basket SDR renegotiation, and then in the other camp, people are saying that China's just going to go in her own route and set things up according to the way we see things developing now, but just accelerating. And frankly, I think both are going to happen because that's just the way China historically does things. They're very savvy. They're going to not necessarily want to be the top dog with all of the responsibilities that come with being the sole reserve currency owner of the world and conduit through which global trade goes through right away. But what is interesting, and I should back up, and that in fact feeds into the strategy of embracing the SDR renegotiation, which could come in fact as early as the third quarter of this year, because the IMF is on track to do its periodic renegotiation. If I remember correctly, they do that every 5 years. But regardless, I know that the renegotiation meeting is going to be in this third quarter. So I'd expect to see a renegotiation of the voting rights and also the composition percentage in the SDR basket itself. But simultaneous to that, we're going to see China and Russia and all the other BRICS and the 24 nations that China has currency swap relationships with for direct facilitation of trade. All of those trends are going to continue to accelerate because it's kind of a perfect hedge for China. And if you look back 5 years, 7 years, and you read the kind of statements that were coming out of the Chinese political power centers as well as people within their own central bank, they would talk about yuan convertibility, renminbi convertibility in 2025, 2030 time frame. And then as of last year, they started accelerating that to saying, and maybe as early as 2018 or 16, you'd have convertibility. And that's actually one of the preconditions to have a fully open reserve currency status possibility with the Chinese renminbi. So, they backed off a little bit when we did all of this currency war against Russia in the last couple of months, and they've been a little bit more conservative with statements like that. But nonetheless, the fact is that they're actually out in the open talking about an acceleration compared to what they were saying publicly 5-7 years ago. And generally speaking, when it comes to the way the Chinese play poker in geopolitics, they actually understate their position, just as they're understating their gold reserve position right now, just to draw an analogy that'll bring it home for people in the gold bug community. So, there's going to be a lot of fireworks when it comes to the change in which the dollar has as its world reserve currency status, and we're going to see some milestones this year. I do not believe we're going to see some major changes within a first quarter time frame. I think it's going to take a little bit more time to evolve. But all of this feeds into what you were talking about financial repression over 5 years. And the bottom line is that when you start changing all of the reserve currency status relationships and the global economic relationships, it makes it less likely that this credit bubble will be able to be dealt with in a longer period of time. That we truly are in the end game, given the moving parts that are demanding address of the situation, and the currency front is one of those moving parts that's going to accelerate the day of reckoning.
Yeah, the currency markets and the bond markets and interest rates, I think, are some of the most important markets, because they dictate all the other asset price markets, which is why, the interest rates have been capped, because if interest rates spiked, real estate would most likely collapse, the stock market could potentially collapse, the bond market could potentially collapse, etc. And currencies would, the exchange rates, which are, being attempted to be manipulated or managed, could get out of whack and blow up. All these different things. But yeah, I think we're in very interesting times for the next 5 or 10 years going forward here. You brought up gold and silver. You put out a piece on a past SD Metals and Markets report underneath it, talking about how you think the gold and silver markets have stealthily capitulated without most people realizing it. From a sentiment perspective, you talk with most people, even most gold and silver bugs at this point, they're pissed off. They don't want to hear. They don't want to hear that gold and silver going higher. They're fed up with it. And you're starting to hear people just turn on the experts now. Even the ones who didn't make a lot of price predictions, but maybe said, look at the fundamentals and things like that. So I think that you're right that the market seems to be at a bottom here, especially with all these defaults. I mean, look, last year. Gold was up, I think, quite a bit in every single currency. It was near nominal highs all time, right, in almost every single currency.
And even in the dollar, it was not a bad down performance for the year. It was like 2%, I think.
Well, considering how much the dollar has strengthened in the dollar index, right? The dollar index had like an all-time high percentage move, or one of its all-time highest percentage move, and the gold price was still pretty solid.
Yeah, and in the fourth quarter, gold started to outperform the dollar. And that's what you look for when you try to find catalysts or tipping points to shifts in sentiment and shifts in trends. And that's what I bird-dogged back in October, where it was pretty apparent that there was something major going on in the gold equity space that was signaling the shift in the sentiment overall for the sector. And that's what that piece is referring to. It's, I think it was, correct me if I'm wrong, you might have it in front of you, but I think it was December 26th when we published that particular Metals and Markets report, and under my screen name over on Silver Doctor's Flying Wombat, people can see it. But even just with a generic, simple picture, a graph display of the GDX and volume year over year, when you compare, just eyeballing it, you can see it. There's an 80-some-odd% excessive level of volume this year versus last year. I mean, the level of turnover in the mining shares was almost total. Anyone that was in it before basically got out. And it was a slow bleeding process that began in 2011 when the manipulation stepped up, and we had lots of different periods where there were false breakouts, and the cartel would come in and smash the sector down, and that process happening over and over and over again over a period of 3 years destroyed sentiment. I mean, we never have seen this level of sentiment. I mean, it's below where it was, not right now, but, in December, it was below periods in 2008, 2009. It was below the previous cycle low, and so it speaks to just the fact that most of the people who wanted out were already out, and you could see that in the mining shares, and that's what now enabled me to be able to make that call. And it's so far it seems that I'm right. You never know with these kind of things because when the Swiss pegged the Swiss franc to the euro back in 2011, that very following week, the cartel came out and just obliterated gold. And back in April 12 through April 15, 2013, we had a gigantic raid that even skeptics of the manipulation thesis couldn't ignore. People like Dennis Gartman was thinking, oh gee, there's a really big seller out here. Well, yeah, thank you very much. 400 metric tons of paper gold sold in the equivalent of a 5 to 10 minute window over a weekend in the most illiquid period of time. I mean, come on. Those kind of things are so obvious that they can't be denied. And anybody that at this stage denying the whole manipulation thesis most articulately advanced by Gada is just choosing to ignore reality. So, I mean, what's going on now in the precious metal space is that I believe we're going to, in the very least, have a decent year, 20-30% up with gold, and there'll be a lot of volatility. And then there's also the possibility that we may have some pretty huge fireworks if we have catalysts that come from the geopolitical space or on the dollar currency reserve status front we talked about before. We could have a huge move in gold. And ultimately, there's got to be some kind of a coordinated reset to the monetary system that will involve banking holidays, that will involve a resetting of the dollar to a different exchange level, and it's not going to be a full jubilee because, bankers don't do those kind of things anymore. But we are going to have some kind of a reset when it comes to this level of debt and the currency systems. And the time frame for that, in my opinion, is probably sometime less than 3 years and as early as maybe 18 months, with significant changes along the path, and one of them may in fact be the SDR renegotiations in the third quarter.
Yeah, when I look at the gold market, Eric, we're starting to see the European countries ask for audits of their gold, and we've had Germany, I guess, get 120 tons of their gold back. That just came out. That announcement just came out recently. We've had the Dutch surprisingly get back, I don't know if it was 120 tons, but it was over 100 tons of gold. So we're starting to see European countries ask for audits. I don't know if it's because they're leaving the euro or they realize the gold's not there, but this is starting to remind me of what happened during the London gold bull, how it broke up, and the cartel that was overtly capping the gold price in at I think $35 an ounce, it just blew up in their face, and then gold just went to $100, $200 an ounce. It had its rough cyclical bear market correction from 1974 to 76, where it got cut in half to $100. Everyone gave up, kind of like what now, and then gold went up eightfold to 800 before Paul Volcker came back and started doing the right thing and protecting the currency and raising the interest rates and things like that. But we don't have a Paul Volcker now. And then also with the gold and silver market, when I actually look at supply and demand fundamentals, we have a lot of people talk. There's so much gold above ground. But it doesn't really matter because a lot of that physical gold doesn't really change hands. So a lot of the gold mining supply is needed to keep the market in balance, to prevent a massive price spike or things like that. So the market's very tight. It's even tighter, I think, in silver than it is for gold. But
and the claims on the gold that's above ground are an order of magnitude multiples over the actual gold. I mean, that's the biggest problem of all.
Yeah, exactly. But the paper gold market, there's just so much more gold or silver being sold, and there's people
I'm not talking LBMA. I'm not talking about COMEX. I'm literally talking about vault storage in the Federal Reserve System and private vaults and so forth. I mean, in those markets where people think they have physical gold, they don't, because there's multiple claims to that gold. It's a huge problem.
Yeah, they're either in unallocated accounts, and maybe they think they're in allocated accounts, or even in allocated accounts, like you have ABM AMRO, I think, defaulting, or what happened with MF
and
Global.
And that's why the sovereigns are repatriating their gold, or at least trying to. And it also should be said that people forget this. When Germany initially tried to repatriate, they were talking about, if memory serves, and I may get this wrong, 1,600 metric tons that they were trying to repatriate. And now, they're scaling that back to some 600 metric tons. So, not only have they gone through the embarrassing period in 2013 when they're only able to get 5 metric tons out of the Fed vault, but they basically were told, hey, you guys got to chill out and not demand as much as you're asking for because you ain't gonna get it. So don't embarrass us. And they've reset the whole expectations on what they would be able to receive.
Yeah, but I think the miners, like I said, though, are they were so close to going bankrupt. So, if gold would have went to $1,100 an ounce or below for the primary gold miners who make up a large percentage of the annual gold mining production, and the primary silver miners, when silver dropped below 18, they were to the point where if the metals had stayed down there for much longer or gone lower, I mean, we were just going to have so many bankruptcies because there's just not debt or equity available, and that metal is, in a lot of cases, I think, like you said, it's already spoken for. So, the metal that's being pulled out of the ground, it's already sold off.
Yep.
So, these markets were just getting so tight and so ridiculous that, I knew it wasn't sustainable. I couldn't have told you exactly when it was going to bottom per se, but it couldn't go on for that much longer. It's just like with the oil price at these levels, maybe in the short term for the next couple months or 6 months or something, the oil price with momentum, the trend traders may take the oil price lower, but it's going to bankrupt so many oil producers, maybe even entire countries producing oil, that it's not sustainable either. So I think we're to those levels. We were going through a lot longer correction for gold and silver for the producers, but we're going through the same type of deal for oil, where regardless of whatever manipulation there's been in the market, there has to be a reality at some point where the low prices force higher prices here because the supply gets cut back or producers go bust and things like that.
Right. And, you'll appreciate this coming from an Austrian school perspective. The realities that we face now worldwide is that we have a systemic debt bubble that's so large that it could very well be that people, instead of as they did in 2008 and 2009, rest on their laurels thinking that central bankers can save the day. The scope of the problems are so great right now that I believe, actually, that we're beginning to see recognition, even in the mainstream Wall Street circles, that gold will perform well during the period of deflation. A lot of people poo-poo that. A lot of people, even in the punditry/analyst community, people like Harry Dent and so forth, think that gold will just get whacked because of deflationary.
He hasn't studied financial history.
Well, there's that too, and I don't want to knock him too hard, but he's going to be proven wrong, and I believe we're already seeing the signs of that in the market pricing action. The tail of the tape is speaking to that. And you see that when gold is outperforming the dollar, even though the dollar has been rising in this last month. And it's corresponding to pricing in of the elevating risk and continuing accelerating risk of the deflationary hiccup or crash. And that's what we're facing in 2015. That's what the Draghi's going to be fighting when he comes out on the 22nd to try to, goose up the QE in Europe, and these dynamics are probably not going to be able to, the central bankers are not going to be able to fight this indefinitely, and we're going to see probably sometime, I don't know, maybe around the end of the first quarter, the old sell and may go away thesis, and when it comes to the equities markets, is probably going to play out because it also fits well with the timing of what's going on with this shale debt overhang and the emerging economies around the world having so much dollar-issued-based debt that's going to come and bite them given the acceleration of the rise in the dollar and all of that stuff, which translates into, a backdrop for precious metals that I think is going to surprise people. I mean, in the very least, I think 20, 30% gold up this year, like I said before, but with the possibility of some amazing fireworks, particularly in the equity space. I don't think we've ever had a period where you had the mining shares down for 4 years straight, and we were already doing 3.5 years when we turned around.
Yeah, those are interesting points, and I think Harry Dent is a really smart guy. I just think people can get kind of stubborn with their viewpoints. He has to sell newsletters, he has to say certain thing. We've read his. I haven't personally read his books, but John Manfredo, Wall Street for Main Street has, and he gave me a summary about them. He only looks at demographics for his views. He doesn't take into account the central banking activity and so many other variables that I think he should take into account. Plus, he hasn't looked at financial history. I mean, John Maynard Keynes made a freaking fortune off buying gold and silver shares during a deflationary period because he knew the Federal Reserve and other central banks back then wouldn't allow it. He knew that him and the other Wall Street insiders months in advance, they front run that trade knowing that FDR was going to confiscate the gold, revalue it higher, and force people back into a devalued dollar.
Right.
That they weren't going to allow pure deflation. So there's really people talking about pure deflations being allowed. In modern history, Eric, there's really not been a pure deflation. I mean, Japan has had their CPI has never really fallen. They've had higher food and energy prices in Japan. I have friends who live in Japan. Their rent prices are high. Take a taxi from the Tokyo airport downtown. It's not cheap. There's not it's not like the prices are dropping like crazy. Maybe in electronics the prices are dropping, but in pretty everyday items to survive, the prices are not really dropping.
Yeah.
So this pure deflationary scare, after 1929, maybe we had a little bit of it in 2008. They didn't allow it. We had a little bit of it, after 1929, and then they kept doing intervention to create inflation. It's just the Keynesian interventionist mindset here.
Yeah.
With the remaining part of the interview, though, Eric, you cover a lot on the News Doctor's geopolitical events. So you cover that really well. I want to talk to you about potential geopolitical black swans. Are we looking at worsening black swans then, either in the Ukraine or you brought up before the interview Saudi Arabia?
Yes, I believe that we will see an escalation in Ukraine. It's already happening actually this week. The Ukrainian government has used ceasefires as time periods to reinforce their military positions, and then they go on the rampage and they attack. Unfortunately, I would say at least 90% of the American audience and European audience, to a lesser extent, but still very, very high, has bought into this propaganda meme coming from NATO and from Washington about Putin being the prime aggressor. I mean, I can't count how many times there were claims that Putin had rolled tanks and had invaded, and there was even one instance where I reported on it. I was literally the only person in the entire Western media to report that a lower-level parliamentarian in the Ukrainian parliament had got onto his Facebook page and started squawking about how tanks were rolling in and in the context of an aid convoy, which in fact was really an aid convoy. But the president of the Ukraine turned around and said, "Hey, the leader in the parliament turned around and said, "Hey, what are you talking about? This is not true." So even they can't get their story straight. Putin didn't invade. The Crimean people had voted over 90% to go back into the Russian fold, and it's on and on. It's amazing the degree to which this propaganda has bamboozled public perceptions to frame Russia as the prime aggressor, when in fact there's been a long history of the West meddling in the Ukrainian political sphere, and the coup d'etat was facilitated. It wasn't 100% directed by the West, but it was certainly facilitated by Western efforts. So with all that said as backdrop, I think that the fact that Congress has already approved hundreds of billions of dollars worth of aid that will in fact be flowing, and the hole that NATO and the West has gotten itself in vis-a-vis this Ukrainian mess, there really is no way for them to proceed other than to move forward with more aggressive military action. And I think we're going to see that before we see anything breaking out in terms of some kind of a resolution in Ukraine. So I'd expect more geopolitical friction between Russia and the EU and the West. But one of the other things that I think will be a big catalyst going forward that's not really seen by a lot of people just yet is that Saudi Arabia has already sustained two terrorist attacks, and that they're talking about building a wall on their northern border that extends the entire length from Kuwait all the way to the west, basically like you're trying to keep out the hordes like the Chinese wall. I mean, it's a very unstable situation. The lower oil price makes their ability to buy off their masses with the royal family riding on top much harder for them to do. I mean, they have a huge amount of reserves, and they can sustain 2+ years of low prices to protect their market share and whatnot. But the fact is that these radical Islamicists that have been stirred up are now turning their direction towards Saudi Arabia as well. And I think that we're going to see some events in Saudi Arabia that are going to surprise people. And that comes on the context as well of the royal family going through a power struggle because the current king is on his deathbed. He's not healthy. And so a lot of change is going to happen there. And just within the last month, we have also begun to see the stepping stones being laid for a propaganda claim against Syria's Assad, and a claim that he's building a nuclear bomb capacity. And it's kind of a rerun of what happened with what the Project for New American Century neocons tried to do back in the day with the justification to go to war against Iraq and their weapons of mass destruction program. So I'd look for a heck of a lot more turmoil going on in the Middle East, way above just what we see now when it comes to ISIS running around and beheading people. And I mean, they've already expanded their footprint in terms of the territory that they control by like some 70%. So, and Venezuela also is going to be an issue. Their economy's falling apart, and you can see a lot more turmoil there. So the geopolitical front is very fluid, and I think that that's going to contribute to putting even more pressure on currency issues like we had talked about before when it comes to how China and Russia react to pressure from the West.
Yeah, according to WikiLeaks documents, Eric, and Kuz Jansen reported this. I read in one of his articles. It looks like the U.S. had been planning to, use the Ukraine to help to destabilize the Ukraine to get back at Putin and Russia. So, they had a multi-pronged plan to go into the Ukraine, destabilize it, hurt Russia that way, put the sanctions on Russia, hurt it that way, attack the ruble, hurt it that way, and then maybe team up with the Saudis in some type of agreement to, knock the oil price down because the Saudis are the lowest cost producer and they can afford a lower oil price easier than some of these other countries. Venezuela is just a basket case. I mean, that's a Marxist country. That can be fixed in 5 or 10 years, just like Cuba can be fixed if, the Marxists leave the country and they allow investment and people to come in and build value in the country so there can be entrepreneurs and job creation and wage growth and things like that. But, until that's fixed, either in Venezuela or Cuba, you're not going to see anything solved.
There's one fly in that ointment, though, and when you get a full-blown civil war that is instigated and motivated by the social economic collapse that's going on there as it accelerates, what will happen is that there'll come a stage where it'll be ripe for intervention by the United States. So that will be what will be the black swan, another front of U.S. military action directly involved in Venezuela.
And the U.S. may go in there to keep the oil production from dropping to zero, because if the oil production drops to zero, I mean, the U.S. politicians thought the U.S. was going to be energy independent, right? And now look at the shale boom. It's backfiring like crazy. They thought, we don't there was a lot of politicians here. You read the mainstream financial media, the politicians here in the D.C. area where I live were saying, you know what, we don't need the Middle East anymore. We don't need Nigeria or Venezuela or Saudi Arabia anymore. We have all our own oil. But now, the oil's not going to be profitable. These oil companies are going to go bust. So we may see, like you said, the U.S. military and other people start putting puppets into Venezuela to prevent, because Venezuela is bankrupt now already. If the oil price stays much lower or goes lower, Venezuela is in even worse shape. We might see a regime change there just to keep the oil pumping in the near future.
Yeah, and even if we lived in a world where oil was still over 100 and stayed there indefinitely for 15 years or what have you, the shale boom that we're having now really is just kind of an echo boom. It's the use of technology to extract the much harder to extract oil that is available only because of the shale technology. And, in 15 some odd years, that boom would completely have played itself out. The shale wells traditionally have been seeing their peak production in like 18 months with gigantic decline on the downslope of their reserve extraction. It's not like these long-lived oil giant fields like the Karwar field in Saudi Arabia that 70+ years of production at 90% capacity of what it's able to do without a single hiccup. I mean, conventional oil is very different from this shale field, and all of these goofballs in our political establishment that were buying into this, even to the extent of not just the United States having the ability to be 100% self-sufficient, but even to be able to supply Europe in the face of Russia and justifying to some extent the actions that we have taken because of this blind faith that, we'll be able to export natural gas by liquefied compression and then shipping it over there in 3+ years. I mean, it's just insane what some of these people think. They're so diverse from the economics and the physics reality, never mind economics, of what's going on when it comes to the petroleum industry. But anyway, that's a chance.
Well, I agree. The politicians are in a bubble here. I mean, they probably thought the LNG export facilities were going to come online in the next year or two very smoothly, but we've seen, the capex cuts for the oil and natural the oil price dropping, right, has affected natural gas investment too.
Yeah,
There's been tens of billions in capex cuts for natural gas projects too.
Yeah, and the natural gas coming from the shale fields was more of a shadow play built on the profitability of the oil and natural gas concentrates that were more profitable. That's what we helped build back the natural gas supply. All of that shale drilling for oil.
Yeah, exactly. And besides just the new technology and the higher oil price that fueled the fracking revolution, it was also the cheap debt. So you had the bank's ability to create this and Wall Street's ability to create out of thin air all this artificially cheap debt. Now that the oil price has dropped for whatever reason, I don't think it was free market forces, supply demand fundamentals. I don't think demand for oil dropped 50% in a couple months. In fact, I think some of the research I'm seeing is that demand is still globally increasing. Maybe in the developed world it's dropped, but in the developing world it's still strong because people bought their first cars and paid cash. So, I mean, the fundamentals didn't justify this price drop.
Yeah, the slippage was very small. I mean, if you compare it to what happened in 2008, it was even smaller than that. So, the overall weakness in economic growth on a going forward basis changed expectations and kind of set the stage for people to think that, maybe $80 oil would be more realistic and whatnot. And then I recall in the early November time frame reading about contracts that Saudi Arabia had negotiated with 5-10% discounts to China, and that kind of set the stage. And that was the late June through July-August period when the oil was being delivered and those contracts were being discounted. That kind of set the stage for a small window of weakness. But then you add on top of that the deflationary expectations of a credit crash, basically, or credit contraction in the whole deflationary process for 2015 onward. Changed the expectations for the market, which set up this condition where it was very easy to come in and manipulate further. So we went down from on the West Texas Intermediate Crude base benchmark from 107 or so to high 95 area, and we were kind of sticking around there for about a month, and then all of a sudden the ruble came under attack, and I'm convinced that was in fact an operation run out of Langley, basically, with hedge fund partners and J.P. Morgan and what have you. I mean, this is all idle speculation. I have absolutely no proof in any of this, but historically those kind of things happen, and maybe they were targeting $80 oil. Who knows? Maybe 70, because as I know from conversations you and I have had before, that Russia's budget was ideally placed at a $90 world oil price, where they'd be able to fund their economy without any stress and manage to fund their debts and so forth. So I could totally imagine a scenario where there was a initiation of manipulation that pushed the ruble down and also oil contracts down after this change in the sentiment for going forward, the expectations for 2015 and beyond, that just got away from people. I mean, it's unlikely that if you operate on the assumption that there was a decision to do some manipulation, that these guys were thinking, we're going to get oil all the way down to $40 handle.
Well, once they broke the support level, I mean, oil since 2010, it had bounced very strongly off of $75, $80 support levels three times. Very, very strong. You look on the chart; it was very strong support levels, and then it just looks like something intentionally broke the chart to me. But
and you know how hot money works. I mean, we got $5.3 trillion forex market on a daily basis, just to give some indication as to how much money's sloshing around in the world. And when the hedge fund guys and fast money traders and the Goldman Sachs operations of the world see momentum in one direction, they pile on, and I think that that's what happened here. The level of shift in forward expectations for supply, or rather, demand, combined with excess supply in the Saudi Arabians wanting to preserve their market share in the declining price environment. I mean, when you put yourself in the shoes of the Saudis at $90 oil, and the expectation that oil is going to fall further, they don't want the shale plays to be able to take up some of that slack. So they were probably motivated to just kind of stand pat when it came to their OPEC negotiations, and I think we can take at face value the statements that they were making when it came to their arguing with their OPEC brethren to say, no, we're not going to cut, screw it. But at the same time, this added layer of manipulation that came in to try to punish Russia, and also Saudi Arabia's intent on punishing or constraining Iran's ability to act more aggressively geopolitically, got the market rolling. And then, you add on the hedge funds, and here we are. It's just momentum that got away from everybody.
Yeah, and now sentiment, so bearish, just like in gold and silver, and people are coming out with lower and lower price targets that aren't based on fundamentals, just based on the chart. So, I mean, the market's the rig count's falling like crazy. There's going to be bankruptcies for the higher cost producers. There'll be mergers and acquisitions. The oil market, I would be surprised if it hasn't started going higher in the next 6 months. That's just my personal opinion, and I think eventually we'll get back to I don't know if it'll be by the end of the year, but it may be 2016. Then we'll get back to like $65 to $85 a barrel oil, which I think is a fairly comfortable range there. And then maybe we'll have a spike then due to geopolitical events, like you said, because there seems to be so many geopolitical stuff that there has to be some type of premium then in those markets to discount some potential black swans where oil production could be shut off.
Yeah, and the only other black swan that could take it in the opposite direction would be just to have a credit implosion, and that you have that phenomenon that we had in 2008 to 2009. And
China would love that, because I think one of the real beneficiaries of this oil price crashing, whether or not I think it's been manipulated, but I think China's been one of the real beneficiaries of this. Like in 2008, when commodity prices went on sale like crazy, China just stocked up. I think they're going to be doing a lot of long-term oil contracts now to either buy up oil production from Russia or Brazil, or cheap natural gas, or maybe go buy 50% of Canadian oil companies or 50% of American shale producers or things like that going forward, so they can get out of their dollar and treasury holdings.
And going back to geopolitics, that's why the United States will take a very active role when and if Venezuela completely implodes, because China's chomping at the bit to get into the Orinoco fields even more than she already has.
Yeah, I agree. The Chinese really see, the energy picture, and that's like one of their key investment strategies is, unlike the United States, China is investing in so many different energy investments across the board, whether that's, natural gas or nuclear power going forward, or some of the new types of nuclear power stuff like liquid fluoride, molten salt thorium reactor. The Chinese are investing, I think, over $1 billion already into it. They have, hundreds of PhDs, nuclear physicists, nuclear engineers working on it right now to eventually, commercialize it and scale it up.
Yeah.
My final question, Eric, is about the currency swaps. You and me have talked with a lot of these. Do you think with the potential new system then, you think we're going to see maybe the Indias, the Brazil, some of these developing countries, either BRICS banks or G20s, are they going to strategically default then on some of their dollar-denominated debt in the future, maybe walk away from the U.S. banking system and the U.S. government because they don't want to deal with their crazy foreign policy, and then start doing deals with Chinese banks or only doing deals with like G20 banks and things like that?
Yeah, that's a great question, and it's going to most likely be on a case-by-case basis when you look at any given country. Russia, obviously, huge incentive for them to do something like that because the entire West is making war on them outright. But a country like India, probably not. It would be more in the interest of all of the BRICS, with the exception of Russia, to go along, to get along, and play this game of working with China to set up separate systems, yet at the same time being open to the West and playing nice with an SDR voting and SDR basket representation shift. And, they're just kind of hedging their bets. And I think that's probably the smartest thing for them to do from a geopolitics, real politics point of view. But we already know that in the case of Russia, as being the best example, these gigantic currency swaps are able to backstop Russia as much as desired. There really is no way for the West to take down Russia economically at this stage, because Russia's economy, in relation to the size of the Chinese economy, is small enough, relatively speaking, to be able to have China be their godfather when it comes to the economic backstop. So there's an example of the kind of power that these currency swaps and credit lines and gigantic trade deals that they're doing with 30-plus year time horizons for delivery of natural gas and oil and infrastructure and rebuilding of the Silk Road when it comes to high-speed rail, and on and on and on. The ability for a country like Russia to just kind of check out and just go turn eastward 100%, much to the chagrin of geopolitical grand poobahs like Zbigniew Brzezinski and their vision of the uber continent of Eurasia being able to be a self-sustaining economic zone, is in fact the reality that the West is creating. We're creating our worst nightmare by having idiot-level analysis governing our geopolitics, but that's where we are.
Yeah, I mean, the U.S. government, with its policies like FACTA and things like that, it's making it more difficult for people, to trade with Americans in other countries, or for Americans operating in other countries to, to run their small business properly. It's just getting so complicated with all these extra capital controls and rules and regulations, red tape and taxes that, it almost seems like intentionally maybe some bureaucrats are trying to make it where it's almost impossible to do business with U.S. or U.S. Companies and things like that now. On those particular dimensions, I think it's more just a product like, as Martin Armstrong speaks of, just the amazing need for Western governments like the United States to let no rock unturned where there's possible tax revenue. So they basically want to go after absolutely every possible means of pulling in tax revenue, and that's really the prime motivation for FACTA and those kind of levels of regulation and dumb policy. But when you look towards the geopolitical frame of reference, it's things like the Trans-Pacific Partnership, where we're essentially trying to ring-fence China and Russia and exclude them from trading in the next level of international relations. And it's dumb. The Trans-Pacific Partnership has a lot of flaws all by itself. It's not about free trade. It's about enshrining crony capitalism and oligopolistic concentration of multinational corporation trade, as opposed to and protecting the oligopolies of international trade, as opposed to promoting free trade. It's a misnomer. But that's another whole rabbit hole. It could be a whole conversation in and of itself. Yeah, I agree. We should save that for the next discussion. I mean, pretty much, all the bills that are labeled, they almost do exactly the opposite of whatever they say. So there is no such thing as free trade in the world right now. Not when you can, as one country to another, you can manipulate your exchange rate, right, to gain some type of advantage, or you can put a higher, import tax or tariffs up and things like that. I just hope we don't go towards the Smoot-Hawley route, which is what helped fuel it crashed world trade and economies, and then eventually forced tensions up to potentially conflict with an actual physical war.
Yeah.
With those trade wars and things like that. Well, we're over an hour. I really enjoyed the discussion, Eric. Consider you a good friend, and I really enjoy our discussions in emails and things like that. Please tell our listeners more about the News Doctors and where they can read your editorials and things like that.
The News Doctors is found at thenewsdoctors.com. And on the lower right-hand margin, you can see a bunch of names, including Wall Street for Main Street. You can see my name, Eric Dubin, and if you click on that, it'll pull up either articles that I've written directly or direct links to the radio production that I do with the doc over on the Silver Doctors on Fridays that gets published on Saturdays. That's a pretty decent place to go just to find in a single central location all the stuff that I do. So thenewsdoctors.com and click on Eric Dubin over on the right side.
Okay, great. Well, thanks again for your time, Eric, and let's talk again soon.
Would love to.